Hello everyone, I'm Steve Savant, syndicated financial columnist and money-colored commentator. On today's show, tax-advantaged income, part 4 in our series on life insurance for indemnification, income, and inheritance. This has now become, I would have to say, a big play in retirement, and people that used to not look at this as registered investment advisors and security registered reps are now looking at this as another area to look at. And everything we're going to talk about here on this tax-free income is based on this being a TAMRA compliant contract, and it's a non-modified endowment, and that we're using the least amount of death benefit under the code to actually accumulate the most amount of money that we can. Well, here's the formula for compound interest, and you know that this is always attributed to Albert Einstein, but I don't think there's any real evidence that Albert Einstein ever said that compounded interest was the greatest formula he ever discovered, even greater than E equals MC squared. But in compound interest, this is the very basic formula, and of course, I use an HP12C, some people use Texas Instruments. When you look at this, this is a basic idea, and if you have compounded interest on a life insurance contract, because remember, it accumulates tax deferred. So you're talking about using compounded interest. This is a major formula and why things work. The longer, the better, and especially if you're doing generational thinking using second to die, which is 2 people on one life, and using maybe a grandmother on one end and maybe their grandson on the other end. That could be 100 years of compounded interest. So that formula should be something that you learn so you can understand what am I going to have at retirement if I get compounded interest of 3%, 4%, 5%, whatever it is. If you say, Steve, I'd like to see that, I have a whole compounded table that shows different rates of return. And if you want to order that, just write me at steve@lifesizesolutions.com and I'll go ahead and send it to you. Now, almost all financial products have expense loads. Almost all of them have associated expenses with them. So when I'm looking at this, I can't look at the nominal rate, the gross rate. I need to look at what the real rate of return is after I take out all my expenses. And some people want to even go farther than that and apply inflation to it. And I think that's great as long as we understand that we're measuring everything at the same level. But to me, everything has expenses. Now, I just want to talk a little bit about this, and this is not negative. I have mutual funds and ETFs myself. But remember, the expense ratio, let's say the fund, the last time I looked, the average expense ratio for a mutual fund was about 80 basis points. I think it's 70 over at the ETF land. It's about average. And the statement of additional information, which is an extra sheet, it's not required in the prospectus, oddly enough. But you can find in the statement of additional information, were there any other charges against your mutual fund or ETFs? And the answer to that is yes. And the average that I've seen is somewhere around 130 to 140 basis points on the statement of additional information. That's on top of whatever the average expense load is, which I'm using right now is 80 basis points for mutual funds. And then there's a cash drag. The average mutual funds cash drag, because they have to keep money liquid and cash for the net asset value, the surrender or the termination at the end of the day. And that number could be an additional 83 basis points because they're keeping some of this money in cash for liquidity, and they're not really putting a lot of money or a lot of credit into it. I think it's probably average about 0.12 credit to their cash positions, but all these other expenses are eating into that. So there's a thing called cash drag, statement of additional information. And remember, if you're in a qualified plan with your mutual funds, I have other expense loads that you have to disclose now, by the way, under the reg that was imposed to us about 4 years ago under 408B2. You have to fully disclose all expense loads in a qualified plan so you know what you're getting yourself into. And remember, if you have a registered investment advisor, the average charge in the United States is about a point. So by the time you start totaling all this up, you're over 4% in mostly all these cases, and that doesn't include any taxable event on a mutual fund, and I'm adding at the bottom term life insurance, whatever that premium would be, because if we're buying life insurance and comparing it to this, we also have to use the same coverage. These expense loads, when you put this all in one area, you'll be surprised. And how many people disclose this to their clients? Not many registered investment advisors or insurance professionals do that. Life insurance, does it have costs? It sure does. And it has a policy fee. It has administration expense. It has a premium load. It has cost of insurance. It has loan costs if you take your own money out of your own contract. And if you're in variable, there are also sub-account management costs. Now, in my view, to take up as an example, if I wanted to know when is the crossover rate, I'd have to be able to go ahead and schedule that out and figure out, but before I did that, I'd have to figure out what permanent product that I have. There are 4 permanent life insurance products that I can use for cash value accumulation and tax-free policy loans and withdrawals to basis, as long as I keep the policy in force for the life of the policy insured. Whoever the policy insured is, that's the person that has to stay alive. So participating whole life, the vanguard of all permanent. Then we invented universal life in the 80s. We came up with variable life actually before indexing. But here are the 4: universal life, indexing. And remember, indexing can use domestic and foreign indices. And variable universal life uses many of the similar mutual fund type formats that you could buy, and you'd be getting tax deferral and, if you set it up correctly, tax-free income as well. So those are the 4 permanent lines of products. Now, how do I know which one I'm supposed to buy for my tax-free income? I don't know until I do a risk tolerance test. I have to find out, is my risk tolerance good enough to be variable, or should I be in participating whole life, because I just don't have the internal fortitude, the kind of characteristics that it takes to go through a market drop. So I may have to look at my risk tolerance first and then look at my timeline. Is this suitable? Remember, if we're talking life insurance for tax, that has to, for tax-free income, that has to be online all the life of the policy insured. So this isn't just long-term horizon, this is a lifetime horizon. And then the third one, when I'm talking about time horizons, the shorter it is, the more I can't use life insurance. So if I'm about a decade, if I'm going to need my money and I need 99% of it, I'm going to have to be slow before I even think about using life insurance for a 10-year horizon, time horizon. The math just doesn't support it. Now, the crossover year for the average fund versus managed life is about 11 to 13 years. 11 if it's a mutual fund. I think it takes a little longer because ETFs are a little cheaper. About 13 years. If you're not in that for at least those minimum amounts of time, you're doing yourself a disservice by buying it. So this is a long-term, or as I've said before, a lifetime commitment, a lifetime horizon. I need to really commit to this. And so those are your crossover years. So if I'm measuring mutual fund and ETFs against being in life insurance, the actual UL, universal life, index universal life, or variable universal life, somewhere in there, those cost crossover points are going to be somewhere in that area. Now, the regulations that we had here changed the map on how we understand things. Life insurance is one of the few contracts left that you can still get FIFO, and there's some caveats to this, but you could get some of your withdrawals to basis out. You don't have to wait till the end game. You could get some of that out now. Just remember, during the first 15 years, a rule that kind of administrates the first 15 years of any contract is called the force-out rule. And just have to be, I don't want to get too much into the weeds here, but you just want to make sure the TEFRA law, or this whole idea of what is this equity and fiscal responsibility, changed the way we take basis out. And we still have one of the privileges of being able to use basis pre-1982. The TEFRA law defines what is insurance and what is investment. Now we have to have a minimum amount of insurance on top of our cash values to define that this is truly insurance and it's not an investment, not just an investment. And then in the 1988, the TAMRA provisions came in on single deposit life, where they said from now on, if you're doing a single deposit life, we're going to treat the taxation like an annuity, which took a lot of the bloom off the rose, so to speak. But we can still play the 1988 and be TAMRA compliant. We just have to actually make several payments. Instead of making a single deposit, we now make several payments. You could probably go as soon as probably 4 or 5 years. Anything earlier is probably buying too much death benefit. But those are the 3 basic regulations that kind of guard and kind of give us our guardrails so that we can understand what we can do and what we can't. I'm going to be looking at the best gender. 90% of the time in my book, it's going to be women. Their cost of insurance is lower. Age. I'm looking at underwriting classifications. And by the way, another tip there, most females, compared to their counterpart husbands, have a little bit better health. So I'm going to get a little more benevolent underwriting on female. Their rates are cheaper. And again, looking at, if I can't find dad or mom and nobody's healthy, I could look at, I could justify a surrogate insured, maybe somebody in the second generation, a son, a daughter, somebody related to me directly. I'd also like to look at what death benefit options will they use. I'm going to look at both of them to see which one gives me the most cash value, and I'm going to look at how to decrease the death benefit all along the timeline. The lower I keep the death benefit, the lower my cost of insurance, the better rate of return I have for the funds that are being credited after I pay my expenses. And then I'm going to be looking at the Crediting rates for index universal life, the S&P 500's 100% probability rate is right around 5.5 using two 20-year tranches. And I'll send you that if you say, Steve, I'd like to see that. And then the gross rate of return for products like indexing were really built to be about 200 basis points over whatever the company's interest crediting rate is. It's really not to be at 9 or 10%. It's really built to be about 200 basis points over their fixed crediting rate. And then a new regulation that came out a couple years back, the AG49 IUL gross rate now, for every carrier it's a little different, but they're all pretty much in the same idea. And then here's the graph of the 10 years, what we call the lost decade, where you saw losses happen inside the S&P 500. And I just showed on the top that what we had was we didn't have any losses in indexing because they use a kind of a hedge position. You can only credit 0 in the worst scenario. And that could be the way to go for you if you think that's kind of, you still want to be in the market, but you don't want the market exposure of a down market. And then lastly, when I'm looking at basic ideas, you're looking at the power of probability. And right now, according to the study that they did, Lincoln did a study, and right now the 100% probability is right around 5.5%, and 7 to 7.5% is the average 85 to 90 percentile that you could actually see this return. So it's interesting when you look at this, you want to look at this for income. And I've just given you the 4 basic mortality chassis that you can use and why it would be great to have tax-free income. Don't forget to watch our next segment on creating a legacy with life insurance, part 5 in our series on life insurance for indemnification, income, and inheritance. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.